This chapter is one of the more important chapters of the entire course, mostly because indexes sit underneath every investment decision we make, whether you realize it or not. When you hear the market was up today, when a fund manager say they beat the market, or when your stock track portfolio shows relative performance, all of that only makes sense because indexes exist. So by the end of this chapter, we're going to be able to understand a little bit about what indexes are actually measuring. We'll look at some different pictures of way we calculate and determine what indexes are, right? We'll also look at index mutual funds and ETFs and how they might work in our investment strategies. But one guiding idea that we want to keep throughout today's lecture is this, right? Performance is meaningless without a benchmark. You can't say a portfolio performed well or poorly unless you know what it was supposed to do. Security market indexes exist because investors need reference points. They're not abstract academic constructs. They are tools used every day by professionals managing billions of dollars. So we need them for performance evaluation, right? The most important use is as a benchmark. For example, U.S. large cap equity fund claims to be actively managed. Investors expected to outperform a relative benchmark such as the S&P 500 after fees. If it does not, investors begin to ask an uncomfortable but necessary question. Why am I paying higher fees for lower performance? Indexes are also important so that we can create and monitor index funds. Indexes also allow companies like Vanguard and BlackRock to build portfolios that do not seek to outperform the market, but instead they want to replicate it at a very low cost. So over time, data showed that active managers failed to outperform benchmarks, not because they're exciting, right, or because mutual funds are out there, right, but because index funds do a better job because they are reliable, transparent, and inexpensive. 3, we want to be able to measure market rates of returns. So indexes are used in all kinds of academic research, economic forecasting, and the asset pricing models. So when finance theory refers to the market return, it's almost always proxied by a broad market index, and the CAPM, for example. The market portfolio is theoretical, but in practice, we often proxy for it in an index such as the S&P 500. We also need indexes for technical analysis and market sentiment, right? Market technicians use indexes to movements to study trends, momentum, market breadth, etc. We also need to have some way to measure risk. So indexes are often used to estimate systematic risk or beta. So when you see a beta reported in Morningstar Direct, it's almost always calculated relative to a market index. This enforces the idea that indexes define the concept of market risk. Not all indexes are created equal, right? They all claim to represent some form of the market, but they produce different returns because of some choices we make in design. Those 3 basic choices are the sample that's selected, what are we actually calling the market, how those components are weighed, and then how they're computed. So each decision reflects a trade-off between realism, simplicity, and practicality. So what do we need to know about the sample, right? Ideally, an index will include every security in the population it represents. It's not practical, though. So when a sample is used for it, it needs to be representative, not just large. The breadth and selection bias, right? A large but biased sample is no better than small. If certain industries, firm sizes, or regions are underrepresented, the index will distort market reality. This is why indexes often rely on non-random selection methods so that they can reflect the market's economic strategy. Consider the Dow Jones Industrial Average only includes 30 firms selected by committee. By contrast, Wilshire 5000 aims to represent nearly the entire U.S. equity market. So once a sample is selected, the next question becomes, how much influence should each stock have? So the weighting method determines how movements are driven. Price-weighted indexes, higher priced stocks dominate the index. So if you are a high-priced stock and that stock has large changes in value, they will reflect bigger changes in the overall index. In market value weighted, it's not high prices, but larger companies, market share that dominates the index. In equal weighted indexes, all companies have the same influence. And in fundamental weighted indexes, there are some economic fundamentals drive weights. Again, each method answers a different philosophical question about what matters most in a market. And then finally, we need to figure out how we're going to calculate returns. We really only have two choices. It's either the arithmetic mean or a geometric mean. Both will have differences. The geometric mean obviously tries to account for differences in time and time value. So again, we have these three different categories, if you will, or variables that we need to understand when we talk about indexes in general. So different indexes experience different percentage changes. So again, they can exhibit different performance even with the same market and the same time frame. Some differences are very obvious, like the U.S. versus international market, but others are very subtle, and it's hard to see the actual changes and differences in the indexes. So understanding the differences can help us explain why two portfolios that claim to be diversified can behave so differently. So what is a price-weighted index? It's an arithmetic mean of current stock prices, which means that index movements are influenced by the differential prices of the components. The Dow Jones Industrial Average is the oldest, widely followed index. It's highly visible, price-weighted rather than value-weighted. So in this case, a stock with a higher price has more influence regardless of the company's economic size. So why does this matter? Well, a $10 increase in a $400 stock affects the index far more than a $10 increase in a $50 stock, even if the second company is much larger in market capitalization. So this can produce some counterintuitive results that might confuse us over time. some of the criticisms of the Dow Jones Industrial Average is, number one, it only has 30 stocks. It has a non-random selection process, and it requires us to adjust a divisor over time. This divisor helps to bias us downward, gives us some downward bias when we have stock splits. So it takes into account the changing nature of the number of shares in the companies as splits, etc., happen. So again, despite these flaws, the Dow Jones, it persists historical continuity and media familiarity. Everybody knows about the Dow. Quite frankly, it's rarely used in research. The Japan's Nikkei index is also price weighted. Of course, it's going to follow the same types of issues and problems that the Dow Jones meets and walks with. The value weighted index, again, this is where the assets are weighted by market capitalization. This gives us a little bit better of a picture from an economic perspective, right? So the market value, again, obviously is calculated as the number of shares times the current market price. So we started with an index value of 0, of 100. Then that new market values are compared to that base index, right? So the advantages to this is it automatically adjusts for stock splits. It reflects investors' capital allocation, and it's dominated by firms that matter most economically. So the indexes like the S&P 500 and the NASDAQ are market value weighted. This explains why a handful of mega cap firms often drive the overall index performance. So here's an example of how indexes are calculated in returns. As you see here, we have a value, a beginning value on December 31st, 2023 of $200 million in these three assets. The price you can see is 10, 15, and 20. Prices changed to 12, 15, and 20. So this one stock changed. So what did that do? The overall value changed to 202. So we can see what it started at. That was 100. Now it goes to 101. How do you do that? You divide them. 202 divided by 200. That is 101 compared to the 100. What happens if the highest stock change? What happened to that? Well, again, it went up by $4. That means that the overall value, the index value, went from 101. In this case, it would have been to 110. So bigger changes because the bigger stock is the one that changed in the index. So that's the end of this video. Look forward to seeing you in the next one.